Hello and welcome to my channel, where I share my insights and analysis on various topics related to investing and finance. Today, I'm going to talk about a very popular and controversial question. Is it okay to invest in gold now? Gold is one of the oldest and most widely recognized forms of money. It has been used as a store of value, a medium of exchange, and a hedge against inflation and currency devaluation for thousands of years. Many investors consider gold as a safe haven asset that can protect their wealth in times of economic and political turmoil. But gold is also a very volatile and speculative asset that can lose its value quickly when market conditions change. Gold does not pay any interest or dividends, and it has high storage and transaction costs. Moreover, gold prices are influenced by many factors that are beyond the control of individual investors, such as supply and demand, central bank policies, geopolitical events, and market sentiment. So how can we decide whether gold is a good investment or not? Well, one of the most important factors that affect gold prices is the real interest rate. The real interest rate is defined as the difference between the nominal interest rate and the inflation rate. The nominal interest rate is the rate that you see on your bank account or bond coupon, while the inflation rate is the rate at which the prices of goods and services increase over time. The real interest rate tells us how much we are actually earning or losing by holding cash or bonds. For example, if the nominal interest rate is 2% and the inflation rate is 3%, then the real interest rate is -1%. This means that we are losing 1% of our purchasing power every year by holding cash or bonds. On the other hand, if the nominal interest rate is 5% and the inflation rate is 2%, then the real interest rate is 3%. This means that we are gaining 3% of our purchasing power every year by holding cash or bonds. Now, why does the real interest rate matter for gold prices? Well, there is a negative correlation between real interest rates and gold prices. This means that when real interest rates go down, gold prices go up, and vice versa. The reason for this is simple: opportunity cost. Opportunity cost is the value of the next best alternative that we give up when we make a choice. When real interest rates are low or negative, holding cash or bonds becomes less attractive because we are earning little or nothing on them, or even losing money in real terms. In such a scenario, we are more likely to buy gold as an alternative asset that can preserve our wealth and hedge against inflation. This increases the demand for gold and pushes its price up. When real interest rates are high or positive, holding cash or bonds becomes more attractive because we are earning a decent return on them in real terms. In such a scenario, we are less likely to buy gold as an alternative asset because it does not pay any interest or dividends, and it has high costs. This decreases the demand for gold and pushes its price down. So how can we measure the real interest rate? Well, one way to do it is by using the yields on Treasury inflation-protected securities, TIPS. TIPS are bonds issued by the U.S. government that adjust their principal and coupon payments according to the inflation rate. For example, if you buy a 10-year TIPS with a face value of $1,000 and a nominal yield of 1%, you will receive $10 every year as interest. However, if the inflation rate is 2%, then your principal will increase to $1,020 after 1 year, and you will receive $10.20 as interest. Similarly, if the inflation rate is -1%, then your principal will decrease to $990 after 1 year, and you will receive $9.90 as interest. The yield on TIPS reflects the real interest rate that investors expect to earn by holding them. For example, if the 10-year TIPS yield is 0.5%, this means that investors expect to earn 0.5% per year in real terms by holding them for 10 years. The TIPS yield also reflects the inflation expectations of investors. For example, if the 10-year nominal Treasury yield is 2% and the 10-year TIPS yield is 0.5%, this means that investors expect the inflation rate to be 1.5% per year for 10 years. The chart below plots the price of 1 ounce of gold and the inflation-adjusted 10-year TIPS yield. The real interest rate is calculated by subtracting the 10-year inflation rate from the 10-year nominal Treasury yield. As you can see, there is a clear negative correlation between real interest rates and gold prices. When real interest rates go down, gold prices go up, and vice versa. For example, between 2003 and 2008, real interest rates were mostly positive and trending downward, while gold prices were rising steadily. Between 2008 and 2012, real interest rates were mostly negative and trending downward, while gold prices soared to record highs. Between 2012 and 2015, real interest rates were mostly negative but trending upward, while gold prices plunged. Between 2015 and 2020, real interest rates were mostly negative and trending downward, while gold prices recovered and reached new highs. And since 2020, real interest rates have been rising sharply from below -1% to -0.60%, while gold prices have been falling. So what does this mean for the future of gold prices? Well, it depends on what happens to the nominal interest rates and the inflation rate. If nominal interest rates rise faster than the inflation rate, then real interest rates will rise and gold prices will fall. If nominal interest rates fall faster than the inflation rate, then real interest rates will fall and gold prices will rise. And if nominal interest rates and inflation rate move in tandem, then real interest rates will remain stable and gold prices will be influenced by other factors. Right now, we are in a situation where nominal interest rates are rising faster than the inflation rate. This is because the Federal Reserve has started to taper its bond buying program and signaled that it will raise its policy rate next year to combat inflationary pressures. The market has also priced in higher expectations of future inflation due to supply chain disruptions, labor shortages, fiscal stimulus, and pent-up demand. As a result, the 10-year nominal Treasury yield has increased from 0.91% at the end of 2020 to 1.64% as of today. Meanwhile, the 10-year inflation rate has increased from 1.96% at the end of 2020 to 2.54% as of today. This means that the real interest rate has increased from -1.05% at the end of 2020 to -0.90% as of today. This rise in real interest rates has been a major headwind for gold prices, which have declined from $1,895 per ounce at the end of 2020 to $1,785 per ounce as of today. So is it okay to invest in gold now? Well, it depends on your time horizon, risk tolerance, and portfolio diversification. If you are looking for a short-term trade, then you might want to avoid gold or even sell it if you think that real interest rates will continue to rise in the near future. If you are looking for a long-term investment, then you might want to buy gold or hold it if you think that real interest rates will eventually fall or turn negative again in the future. Gold is not a one-size-fits-all asset. It can be a good investment or a bad investment depending on the market conditions and your personal goals. Gold can provide protection against inflation and currency devaluation, but it can also lose value when real interest rates rise or when investor sentiment shifts. Gold can diversify your portfolio and reduce your overall risk, but it can also increase your volatility and opportunity cost. Therefore, before you invest in gold, you should do your own research and analysis, and consult with a professional financial advisor if necessary. You should also monitor the real interest rate trend closely and adjust your position accordingly. To summarize, here are the main points of this video. 1. Gold tends to become more valuable when the real interest rate is trending downward and less valuable when the real interest rate is trending upward. 2. The real interest rate is defined as the difference between the nominal interest rate and the inflation rate. 3. The yield on tips reflects the real interest rate that investors expect to earn by holding them. 4. There is a negative correlation between real interest rates and gold prices. 5. Real interest rates have been rising since January 2022, from below -1% to -0.60%, and it is likely that real rates will continue to rise and turn positive in the near future as the Fed tightens its monetary policy and inflation expectations increase. 5. This rise in real interest rates has been a major headwind for gold prices, which have declined from $1,895 per ounce at the end of 2020 to $1,785 per ounce as of today. 6. Whether gold is a good investment or not depends on your time horizon, risk tolerance, and portfolio diversification. You should also monitor the real interest rate trend closely and adjust your position accordingly. That's all for today's video. I hope you learned something new and useful. If you enjoyed this video, please give it a thumbs up and subscribe to my channel for more content like this. Also, don't forget to hit the bell icon to get notified when I upload a new video. And if you have any questions or comments, please leave them below and I will try to answer them as soon as possible. Thank you for watching and I'll see you in the next video.